Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be talking about Accenture, ticker symbol ACN. Let's get to it. All right, so for today's agenda, we're going to look at 2021 Q3 results. We're going to give a brief business description, look at the stock price history, price performance versus its peers, market cap history versus the price to earnings. We're going to look at the fundamentals, revenue, debt, shares outstanding, free cash flow. We're going to go over dividend information. I'm going to give my price target and then some final thoughts. If you like this type of content, please consider subscribing. Also hit that like button at any time. And now to the content. All right, so looking at 2021 Q3 results, the analyst had Accenture bringing in $2.24 per share. The results were $2.40 or a beat of 16 cents, a 7% beat there. On the revenue side, Accenture reported $13.3 billion in revenue for the third quarter, beating analyst expectations by $490 million, or about 3.8%. Analysts had anticipated $12.81 billion. At an extremely high level, Accenture provides professional services to basically every industry in the business. They'll do government, they'll do private sector, healthcare, oil and gas, technology, you name it, they're in it. They provide professional services, consulting services to these various industries. All right, so Accenture's trading at $285.70 a share. They're up 156.35% in the last 5 years. If you bought them at the bottom of the pandemic low, you're up 90%. When I bought them, they were actually when I first learned about Accenture, it was back in June of 2014. They were about $80 a share, about up 250% since that time frame. They've done fairly well. Really great performance since then. If we move over into the market cap, since that 2014 time frame, they've gone from about $50 billion up to 180, so a little above 3 times where they were at back in 2014, and they dropped down to about 95 billion during the course of the pandemic, or shaved off about $30 billion in market cap. The thing that really concerns me here is their price to earnings ratio in comparison to their stock price. So back in 2014, they were trading, in the mid-teens. Before that, they were trading, 13, 14, but lower teens. Obviously, you had the dip here for the recession in 2009. And then they started having this gradual incline between 2017 and 2018, where they traded in the mid-20s, about 25 for about 2 years. And then for the last 3 quarters, they've actually been trading right in the 30 P&E, and currently they're trading at 33.85, which to me is very high for their stock, especially when you look at it historically. All right, so I wanted to look at their price performance versus the S&P. I also threw in one of their competitors, CGI Group, ticker symbol GAB. So you can see that Accenture's up 148% in the last 5 years, GIB at 106, and SPY, which is the S&P 500 index, at 95%. Please remember to hit that thumbs up button. It helps me out a lot with the algorithm. Now back to the content. All right, so jump into the financials. Let's look at total revenue. So total revenue grew between 31 billion and 44 billion at the end of 2020. Revenue growth 3.4, 5.9, 10, 13, 5.4, and 2.5. So we had a couple slower years after 2 big years in 2017 and 2018. Looking into full year 2021 and 2022, analysts are expecting about $49 billion. Let me scroll in here for you guys. $49 billion for fiscal year end 2021 and 53 billion. If we look at what a revenue growth that would be, it'd be about 12.7 between 2020 and 2021 and 7.9 between 2021 and 2022. If we go back into their gross profit, you can see that has been slowly going up. Gross profit margin looks to be holding steady. EBITDA margin has been increasing. good to see there, as well as their net income margin has been increasing in the last couple of years as well, and also as top line's been going up. Good to see. If we go into the balance sheet, we'll look at their cash and see $8.5 billion in cash, short-term equivalents. If we look at their current liabilities, 12.6. So their current liabilities are considerably higher than what they currently have in cash. Curious if this is normal for them. 12, 11, 10. Let's see what they got back here. Yep, looks to be like it's fairly normal, and they've been performing well. So I typically would be concerned having less cash than your current liabilities, but it looks to be something they've been dealing with, and they're fairly good. They've done fairly well with that capital structure, it seems like, in the past, so I'm not too concerned about that. Moving on into cash flow, free cash flow. If we take their cash from operations minus it by capital expenditures, we'll have free cash flow. So let's see, it's about 7.6. Okay, let's see. Let's just type a calculator here. 181.54 divided by 7.6 give us 23.8 times free cash flow. That's not bad, actually. So their price to free cash flow is much more reasonable than their forward P&E. So actually, I like that. I like that. So let me check that out as compared to another year. It's end of 2019. All right, so if we go back to 2013 or 2019, August, right about here, 123.2. So we'll do $123 billion. Just some rough estimates here, but definitely is interesting. So 123 billion divided by their other number. So this is right about 6.2, 6.02. 20. So they went from about 20 times free cash flow at the end of 2019 to 23 times free cash flow in 2020. You know, don't like seeing those multiples increase, but this is definitely a better buy. Let's see it 2018 because I'm a little curious here. 2018 August. So we're looking for 8 of 2018. Let's see. 104 billion, and we have about 5.4. So say 104 billion divided by 5.4, got about 19. So multiples definitely increased substantially. I would say substantially higher than the last 2 years. There's a little multiple increase between 2018 and 2019. Definitely, 3x, not really 3x, but 20 to 23 is a little fast increase for what you saw in terms of revenue growth. Just to pull that back up, you saw revenue growth of only 2.5%. But you do see revenue growth moving forward into 12, and I think it was 12 and then another 7 or 8% the following year. So back to higher growth years. However, the P&E is definitely a lot higher, as well as the price to free cash flow at 23 is also higher. All right, so real quickly, shares outstanding. There's really not much to look at here. They issued some more shares in 2018, but they've been buying them back since then. And it's just been a very, very small amount of buyback. So 643 down to 635, really nothing there. All right, so currently Accenture does issue a dividend at 88 cents per quarter, or $3.52 per year. And that comes out to an annual dividend yield of about 1.2%. All right, so for my price target for Accenture is not super glamorous, about $300 in the next 12 months. Indicating about a 5% upside. Now, I do think there's probably some short-term risk here. I do think they probably have about a 12% downside. You could see this fluctuate down into the 250 range. Could be a little lower than that, but I do think that they're going to see some growth. There's a lot of extra spending happening right now in the government space, so they're going to definitely be beneficiaries of that. All right, so for my thoughts on Accenture, they're definitely top of the line consulting firm, really great customer service, really great customer results. What I'm really concerned about Accenture is their multiple expansion over the last couple of years, especially specifically looking at price to earnings. So moving from about 16 in the in the mid teens into the mid 20s, and then now we're in the low 30s, all in the course of about 7 years, really does concern me. That's pretty rapid expansion in that price to earnings multiple, and they're not a high growth company. While they are going to see 10%, or they're expected to see 10% between 2020 and 2021. That doesn't. If you just look at their their growth over the last 7 years, you'll see some high years and you'll see some low years. And I don't think last year's low number was just because of COVID. Even the year before that was in the 5% range, and there was some from years about 5 years back where they were again having a slow year. So you're not seeing consistent 10% growth in this company. So it's, and then as they become larger, it's going to be harder and harder to find growth in this company as well. But I do like them, consistent cash flows. Their free cash flow is definitely expanding. They're keeping their capex fairly consistent, and their free cash flow is growing a lot faster than their capital expenditures are. Really love to see that. They're not issuing a ton of shares. They're also not buying back shares, so a little neutral there. Dividend, they got a low dividend yield of about 1.2%, and their price target isn't super lofty on this one. And I do think there's some short-term downside risk if there is some pullback, or you could see this name drop considerably. But overall, good company. If you're investing for probably the next 10 years, I think you're going to be good. But if you're doing anything short term, you might want to watch out